All right, glad to have you back. Foreign direct investments into Nigeria surged to its highest level in 3 years, buoyed by policy reforms of government that have made investors more bullish on Africa's most populous nation long-term prospects. FDI rose marginally by 5.97% year-on-year to $126.29 million in the first 3 months of 2025, up from $119.2 million last year. However, on a quarter-on-quarter basis, investment declined by approximately 70%. That's according to the National Bureau of Statistics. Though analysts consider the direct inflows materially low, the steady rise indicates a renewed appetite in an economy that's chronically dollar-starved and marked by unpredictability. After being sworn in to office 2 years ago, President Bola Tinubu scrapped a long-standing petrol subsidy and relaxed currency rules on a move that made the economy more market-driven, as opposed to the artificial controls that kept the country on its knees. Mr. Gabriel Idahosa is my guest. He's the president of the Lagos Chamber of Commerce and Industry. It's good to have you on the show. Good afternoon, sir.
At the composition of that inflows, you'll find that a significant part of it, over 90%, is foreign portfolio investments, which is an endorsement of the monetary policies that ensures that inflows and outflows out of the economy of foreign currency is now much more liquid. So there's a much improved confidence in the liquidity of the foreign exchange market in terms of investing short-term and being able to repatriate your investment very quickly in response to market conditions. But what is more important to the growth of the economy, the FDI, the foreign direct investment, which is way below 10%, it should be a matter for concern that the policy reforms around making the economy to have a less medium and long-term risk picture has not yet convinced foreign direct investors to bring in very significant investments. Of course, it is early days in the reforms as far as foreign direct investors are concerned. They take a much longer term view of the economy before they commit. But we do have already some expressions, very firm expressions of interest for significant foreign direct investments. Also, a lot of foreign direct investments tend to flow slower than foreign portfolio investments. The foreign portfolio investor can decide overnight to invest very quickly. But a foreign direct investor will take some time to look at the project and begin to release the fund over a long period. So this pattern is not much of a concern, but that as we grow, the reforms and the reforms consolidate, we will see a lot more foreign direct investments higher than, in terms of percentage, than the foreign portfolio investment we are seeing now.
Many would say the FPIs, as the foreign portfolio investments, are kind of hot money that could come in and go out at any time. Yes. You also said that it's too early in the days of the reforms to start talking about FDIs. So how do we balance this up, considering the fact that we want more stability with our currency and investors' confidence drive in our economy?
That's why we are seeing early days in terms of seeing the benefits of the reforms, because hot money will come first, naturally. And a lot of the hot money is like testing the grounds. How long can this last? So as the policies consolidate and foreign portfolio investors see that perhaps in 1 year, 18 months, 2 years, the foreign inflows are liquid, you can invest and take out your money, then foreign direct investors will follow. They usually will follow when they see that the market has settled down, liquidity is good, there's consistent foreign financial policy and fiscal policies. There is no immediate likelihood of policy flip-flops or any sudden changes in policy. And we are seeing the government consistently reassuring that these policies are here to stay. So legislative actions are taken to consolidate some of these policies. We have seen that in the petroleum industry. We have seen that now in the insurance industry. And so in each industry, government is putting legislation in place to support the reforms. We have seen that in the power industry, legislation there to support power reform so that an industry like power sector can now rely on a very solid legislative framework around the Electricity Act, the national, and the electricity market now controlled by states. We will expect to see a lot more foreign direct investment as the consistency that we now see continues. Certainly, perhaps by next year, short quarter of this year, next year, we'll begin to see a lot more foreign direct investments. Some of these have already been committed. Agreements are signed. Groundbreaking is happening around the country for some foreign direct investors, and then the huge funds will follow. So we expect to see significant traction in foreign direct investments.
In the last briefing you had regards Nigerian economy, you talked about BRICS alignment, tariffs hike worsening Nigeria's troubles. Tell us more about that, particularly at this time where Trump is still standing so tall with regards to his tariffs.
I think we wanted to be clear about that, because there have been questions raised to us, like you're asking now, what is our position on BRICS?
Okay.
We need to be very clear that Nigeria should get into BRICS fully, not, well, starting as a partner now, but go full hug. And the point should be made that a country like Nigeria does not require the permission of any other country to design its foreign policy and foreign trade and foreign financial or investment relations. The fact that the BRICS countries, 3 BRICS countries, Brazil, China, and India, are some of the fastest growing countries, economic countries in the world. And part of that is because they have built the BRICS as a very solid part of the world economy. The BRICS economy now is gradually becoming almost 50% of the world economy. So that strength is something that any nation like Nigeria should belong. Already you have countries like Ethiopia, Egypt are there. But the advice we gave was that while doing that, we should prepare for the reactions of America. And for Nigeria, those reactions will only create very minor ripples in Nigerian economy, because the Nigerian trade with America now is very, very, very low. In fact, less than 5% both import and export. And so the impact will be minimal if America continues to drive the traffic game and threaten even more tariff. It will be minimal, but it's important for government to prepare. And the point we also made is that no country, including Nigeria, should be afraid to negotiate and not to negotiate in fear. We cannot afford to negotiate with America in fear, with our hands tied behind us. We must be able, as we are now, to negotiate with America if the need arises, with the best interests of our country in mind. That is what we are saying. But certainly we need to be part of the BRICS and have access to all the benefits that the current BRICS members enjoy. That's really the summary of our statement as far as it regards our membership of BRICS.
Now, the inflationary hike that we see, at least a bit of shift in the month-on-month, high energy costs, exchange rate depreciation, and of course, high cost of living. These are some worries and contending issues that have been on the front burner. I don't know what you made of that during your speech, and are there quick wins for government? I keep asking analysts and experts like you for your views to address the fallout of these policy reforms.
Well, because of the fundamental nature of the reforms, particularly the big reforms, the foreign currency convergence, the removal of the fuel subsidy, it was clear that if you take some time to deal with the effect of those reforms and have the benefits trickle down to our dining table as Nigerians, and that is what we are going through now, because the issues around those reforms had been lingering for over 40 years. And we expect that when you address it frontally as the effects will go away within a few months. That was not going to be possible. But what is certain now is that we have started the steps to address it. First is dealing with the main drivers of inflation. There are two main drivers of inflation: imported inflation from the volatile foreign currency movement that we used to see. So foreign currency movements now are pretty stable. In the last 1.5 years, it has been stable around the 1,500 figure. And so that is helping to temper the inflation. The other major drivers of inflation are food and transportation. In the area of transportation, government has started the process of dealing with it by moving away from petrol and diesel fired transportation to gas and electric vehicles. So it's going to be a gradual process of reducing transport inflation as we see more and more vehicles that are gas or electric vehicles on the road. It's going to be slow but steady, but in parts of the country where you either own a car that is running on gas or you drive on a bus that is running on gas, you find that the transport costs have really come down. In some states where there's significant traction, like Ogun State, there are a large number of people that will say that transport costs have come down. So it will take some time for the whole country to feel that. Now, the big one, the biggest elephant in the room, if you like, is food inflation. Because to address food inflation, you need security in rural areas, in the suburban areas where all the food is produced. In order to have security, you need a sustainable security architecture. And that has to be built on nothing else but multi-level policing. So multi-level policing is just not a security issue to keep our people safe. It's a major economic policy issue to bring down inflation. Until we can keep our rural areas safe and farmers can leave their homes in the morning, work the whole day, and sometimes, as used to happen, have a farmhouse where they can sleep overnight and continue working, the food inflation will continue because we are not producing enough food. And the latest figures show that actually the agri sector is not growing, and it's actually contracted by about 1% in last figures came out. Other sectors were driving our growth, like creative and information technology services are driving our growth. But manufacturing and agriculture are suffering because it is simply not safe for most farmers, big farmers, small farmers, to produce all the products that they ought to produce to bring down food inflation and increase the supply of raw materials to our factories and also bring down the cost of raw materials. So that is a fundamental government challenge that, as you say, that's one quick win. The government, federal and state, put their act together, get policing on the non-exclusive list so that federal government, the state government, and other subnationals invest heavily in security, sustainable security that operates on the ground level and secures each village, each rural community, each rural highway, each major highway that crisscrosses our countries. That will bring down food inflation and help to bring down even transportation inflation.
I must thank you so much. That's our time. President, Lagos Chamber of Commerce and Industry, Mr. Gabriel Idahosa, thank you for joining the program. We appreciate your time. Do enjoy the rest of your day.
Thank you.